Hello everyone, welcome to my channel. In this video, we would be covering the topic International Trade Finance, meaning, introduction and importance of the same. We have already uploaded the playlist on International Trade Finance where there are many videos covered, so you can go check the link to the playlist on the I button in the description box as well as at the end of this video. Now let's start with this one. Starting with the introduction to trade finance, it represents the financial instruments and products that are used by companies to facilitate international trade and commerce. Now, in a very simple way, it facilitates business across borders, across countries. Okay, so if you are running a shop in India, for example, and you want to sell your products to other countries as well to grow your business, for the expansion of your business, now here is how trade finance will help you facilitate the transactions on a global level. So trade finance generally provides the financing options, provides with the documentations, the rules and regulations that needs to be followed, and all those things that can make the transactions across the countries more convenient and mitigate the risk that is involved in it, because you as a seller, you are located in another country, buyer is located in another country. There is a huge risk involved which can be of different types. So for example, if as we took the example of being a seller who is based in India, and you want to sell your products to different countries like US and Germany. Now you have several questions like how to make shipment to another country, what would be the agreement papers involved, how would you receive your payment, what if the other party refuses to make the payment, what if you have shipped the goods and after that there is a default on the payment, what if the goods that you shipped were in a proper conditions but on the transportation to the another country it got damaged, who will bear the risk of the same? So there are so many risks involved when we are talking about trade transaction at an international level. Now this brings us to our second point, which says that the function of trade finance is to introduce a third party to transactions to remove the payment risk and the supply risk. Now here, the third party refers to banks and financial institutions or companies which provides with different types of loans to help with capital needs, which provides with different type of products like letter of credit, bank guarantee. If you want to learn more about trade finance, I've already covered about letter of credit, the bank guarantees and all these videos. You can just go through the playlist. So banks and financial institutions also provide with these kind of products, and then there are insurances which can mitigate the risk involved and also helps with the advisory services if you have several questions on how to be within the rules and regulations by not going against the rules, and then making all the payments in a proper way, the customs, the duties involved, the taxes involved. And because there are transactions happening in different currencies, the risk involved in particular international trade transactions. So to help you out as a seller, as an exporter, or even to safeguard the importer or the buyer, the trade finance involves third party, which is bank and financial institutions, who is having an expertise on all these matters and can guide you through the proper channelizing of your business transactions. According to WTO report, about 80 to 90% of world trade relies on trade finance, and the same it's still growing. So this is how important trade finance is, and in the coming years it would be more convenient, more popular, and always there are certain rules which are being imbibed to make it more safe for the sellers and the buyers, for the exporters and the importers involved in international trade transactions. Coming to the trade finance products and services. So basically, as we are talking about the meaning and introduction to trade finance, there are several products and services involved, starting with the first one, inward and outward remittances, which you should have a basic idea of what exactly it is. So inward remittance is transfer of money from a foreign country to your resident country. Now, again taking the same example, if you are a seller, you are based in India, and then you have shipped your goods to another country, US, and then from there the buyer has made you payment, so it would be an inward remittance for you. Remittance means the payment, so it would be an inward remittance for you. So inward remittance is transfer of money from a foreign country to a resident country. Now, this payment could be for the goods that you have sold, for the services that you have provided. It can also be for family support. Someone of your family is working in US and regularly sending you money to India to to provide a support over here. So that could also be a reason for inward remittance. Someone based in US, your relative, can give you certain remittance or transfer of money as a gift, so that could also be a reason for inward remittance. It can also be for investment purpose. If certain if person based in a foreign country want to make investment in India, they can provide the remittances and it would be considered as inward remittance or foreign investment. So there are inward remittances involved for products that you have sold, the services that you have provided, and all these reasons. Similarly, outward remittance is transfer of money from your resident country to a foreign country. Now, it can be for exactly opposite reasons. For example, you have purchased any goods. Now, you need to make payment. You have purchased goods from US based seller, and now you need to make payment. So, it would be an outward remittance for you. The money is going, the money outflow is happening. So wherever it is outflow of money, it is outward remittance. Wherever it is inflow of money, it is inward remittance. So for goods that you have purchased or services that you have taken, or for support of your family that is based abroad and you are sending money to them, it can also be a reason for outward remittance, or as we mentioned, gift and investments also. So, inward and outward remittances means transfer of money, inflow and outflow of money involved at global level. And because it is happening in different currencies, so there is currency exchange rate involved. So, because you are based in India, you are earning in rupee, and you will be sending money to US, which would be then converted to dollar to be utilized over there. So, there is certain exchange rate involved because currency is being converted, so the money value would be converted accordingly. And as we know that currency exchange value also fluctuates with the market, so there would be differences of the value that you are sending or receiving money from. Second is pre and post shipment finance. Now, not to lose out on any opportunities and to properly utilize the capital whenever the business requires in trade finance, pre and post shipment finance option is provided to the exporters. It is a kind of, you take it as loan that is given to the seller involved in a business, loan that is given to the exporter involved in international trade transaction. Pre-shipment, as the name suggests, it means that before shipping the goods to another country, there are certain requirements that you need to fulfill and you are falling short of capital for that. For example, you have received a bulk order from US, you are running a textile business in India, and you have received this bulk order for 50,000 of garment pieces to be sold. Before you make the shipment, you are running short on the capital that is required to manage the order. Now, you can take pre-shipment finance, which is also a kind of loan from bank or any financial institution for purchasing of raw material, for production process, the cost of production that is involved, for payment of labors that is to be made, for all these purpose that is involved before shipping the goods. To serve all those purpose, all those working capital needs, you can take pre-shipment finance or loan. Similarly, post-shipment finance, as the name suggests, it is after the shipment of the goods has been made and before the payment is received. Now, in this, mostly in international trade transaction, what happens that as a seller, you have sold the goods, but that goods would be transported by different means, whether it is going through sea route or air route. It would take certain days. There would be certain time period involved. And there is a lot of things involved in this whole process, like inspection of documents, inspection of goods, the documentation that is the documentation involved in trade transactions are huge, and those need to be properly managed, properly inspected. So all those things would be done. It would go through customs, the duties would be paid, the insurances would be taken, and after that the goods would be shipped from one country to another. There again, the buyer or the importer will receive the goods, the inspection of the goods would be made, and accordingly the payment would be routed through the bank or financial company that is involved. Now, in all these process, generally it takes certain time period. It takes certain a good amount of time period, like 30 days, 60 days, 45 days, 90 days, or even for long term projects and purposes, it takes more than that. In that case, what happened? Business needs to be run, and there is requirement of funds that need to be served. You can't wait for the payment to be received by the importer after so long. Until then, you are losing on any kind of opportunity, because you are not having adequate fund, adequate finance or capital in your company. So to manage all these things, post shipment finance is also provided as an option, that it might take several weeks or months for you to receive payment, and till then the capital requirement that is there in the business, that can be solved through post shipment finance. So pre and post shipment finance, both the options, as loan is provided to the exporter so that they can manage their adequate capital needs. And of course, because it is loan, there is interest involved, and there is interest involved which is charged to the exporter. And once the payment is received, the loan is repaid to the banks or the financial company from where it was availed. There are financial products involved like letter of credit and bank guarantees, which play a huge role in mitigating the risk, in reducing the risk that is involved. As we said, that the main risk involved in trade transactions are like both the parties are located in different countries and they cannot fully trust on each other. What if the other party makes default or makes false claim, or there is no such entity, or what agreement or contract papers need to be made so that it can be routed through a proper jurisdiction in case it would be required. So financial products like letter of credit and bank guarantees that are provided by banks and financial companies help safeguard both the parties in this transaction. Letter of credit is like a promise from one bank which is made to another bank that guarantees payment to seller once certain conditions are met as per LC. So LC documents are prepared. There are certain terms and conditions that is mentioned in that particular LC, and only when those terms and conditions are fulfilled, the payment is guaranteed to be made. And because LC is a vast term, and if you need to learn more about it, you can go through the video of LC and bank guarantees. That would be you can just go through the playlist link. There are different videos uploaded on letter of credit, and bank guarantees are also there. So in case you want to understand it in a more elaborate manner, I have already explained, so you can just watch those videos for reference as well. Bank guarantee also is a kind of promise which is made by banks or financial companies to pay a certain amount if the buyer fails to make the payment to the seller and defaults. So here it is total protection being given by the banks and the financial companies, that if the importer, after receiving the goods, defaults on the payment, does not make the payment for any reason, me as a bank will make you the payment. So I guarantee you that payment. So bank guarantee serves like a promise to pay certain amount on default. There are insurance products involved in trade finance. So these insurance products are various, like marine cargo insurance, freight and custom insurance, professional indemnity insurance, trade credit insurance, etc. So giving you certain examples that as we talked about the risk that is involved in this whole international trade transactions, there needs to be insurance in place so that it can be served to provide the coverage as and when there would be requirement. Now, trade credit insurance is basically to protect the customers from financial burden if the other party makes default on payment. As in any simple insurance, you need to make certain premium payments, and once the risk is there, once the loss is there, the financial burden is there, you can make a claim with the insurance company and get the coverage accordingly, keeping in mind that the terms and conditions mentioned are met properly. Similarly, there are marine cargo insurance, because the goods that is involved in trade transactions are huge and that needs to be packaged properly and then need to be routed through sea or airway or land. Different routes are taken. There are chances of natural disaster, there are chances of accidents or theft happening in between the journey. Then who will take the risk? Who will be responsible for the financial burden? So marine cargo insurance again, the coverage to those coverage provides the coverage in case any such loss happens due to any natural disaster or accident or theft, and so that you, as a party involved in trade transaction, you don't have to feel that financial burden. You can make a claim and get the coverage. Certain premiums are paid on regular basis. Similarly, there are also freight insurance, there are custom duties insurance, then there is professional indemnity insurance, which covers the cost of legal claims arising from professional services provided in all these trade transactions like consulting, advisory, brokerage. In case any legal claim is made, all the cost that is involved in legal claims, that is covered under professional indemnity insurance. So there are different types of insurances in trade finance as well. Factoring and forfeiting. We talked about loans that can be taken by the exporters before shipment of the goods, after shipment of the goods to solve the working capital requirement. There is one such option also provided, which is discounting of bills. Factoring and forfeiting is kind of discounting of bills where the seller can show the invoices. Invoices are rates. So whenever a trade transaction is made and you are shipping the goods to the buyer, you will be making invoice on the name of the buyer that this particular amount need to be paid after certain period of time. These particular goods are there which are being sold to this particular party. So the invoice will be mentioning all the amount, all the details, and that invoice can be used to get the fund instantly, because you know that you as a seller, you have shipped the goods and then the payment that you will be receiving would maybe after certain days. So if it is for short term period like under 90 days, it is generally called factoring. If it is for longer time period, 90 days to more than 90 days to 5 years, it would be covered under forfeiting, and both serve the same purpose. So the invoices that is raised on the name of the importer or the buyer, that can be showed to the financial company and get it discounted to get the instant fund. And of course there would be charges which is to serve the purpose of the banks and the financial companies involved. Let's talk about the key players in trade finance. Till now, we saw the importance of banks and other financial institutions which act as third party to mitigate the risk, to provide with different financing option, to help manage the loans properly, to help manage the documentation purpose and the rules and regulations. Banks and financial institutions plays the major role and are the key players in trade finance. Importers and exporters between whom the trade transaction is happening, the whole contract is being made between the importer and exporter based in different countries. Importer is the buyer, exporter is the seller. So these are also the key players. Then there are underwriters, which basically are those financial professionals that evaluates and assess the risk involved in a particular transactions. Then there are insurers, which provide insurance to these parties involved to cover the risk and get the coverage as and when there is any loss. Let's come to importance of trade finance. The first one is facilitating global trade. Trade finance facilitates global trade by reducing barriers to trade, providing financial assistance and increasing market access. So this is the first importance and the most major importance of global trade, of trade finance, that it is facilitating global transactions. Now it has reduced the trade barriers. You being a seller situated in one country, and if there is demand of your products in another country, you can sell your products. You can reach out to bank and financial institutions to provide you with financial assistance and increase your market access. You can expand your business. Working capital management. It provides businesses with working capital needed to finance their daily operations, including purchasing inventory, paying suppliers, managing cash flow. So we saw that how capital need to be managed in a particular business to not miss out on any opportunity and to run the business smoothly. And mostly when we are talking about international trade transactions where the funds received are after a certain time period, because the time period involved in shipment of goods and then receiving of goods and then the payment made is huge. So till then, the cash flow needs to be managed, and trade finance options helps with working capital management properly by providing options to the exporters. Financial assistance. We talked about pre-shipment loans, post-shipment loans, which are provided to importers and exporters in need of funds for various business purposes. So there are different financial assistance that is also provided through the trade finance. Risk mitigation, we talked about products like bank guarantees, products like letter of credits, which involve bank as a third party, as a mediator between the importer and the exporter. And then when the transaction is happening through banks and the financial institutions involved, then the trust is built up and the risk involved is lessened. So there is also guarantee which is made to make the payment in case of any default happens. There is proper documentation which happens related to the transportation documents, the invoices, the packaging documents, the all these documents which are properly checked by the banks and the financial institutions involved. So there is a kind of confirmation, because the sellers and buyers involved, they need not have the expertise in all these documentations process. So the involvement of banks and financial companies, they mitigate the risk. They make sure that the transaction which is happening, the trade that is happening, it is in accordance with the laws implemented, it is in accordance with the rules and regulations, and all the documents are made accordingly. Supply chain efficiency. It also helps streamline the supply chain by providing better financing options that enable business to better manage their inventory, production, and distribution. There is a kind of technology transfer, because global trade is happening, because there is exchange of products and services between different countries. There can also be exchange of technological mechanism that is being used. So production process in one country might vary from the production process in another country. The equipments that are used, the machines that are used can differ from country to country. In case the global trade is happening, there is exchange of these technological transfers. Global competitiveness. It can help business improve their competitiveness by providing access to the financial resources, risk management tools needed to compete in the global market. We also talked about the advisory services that are provided by trade finance. That is to make the sellers and the buyers aware about the global market and to let them compete at a global level. Foreign investments. It encourages foreign direct investment by providing the adequate financial infrastructure to support in foreign investments. And we know that how important it is to get the foreign investments in a particular country, because the currency involved, if we are getting a foreign investment from a country which is having a higher currency value as compared to our, it would be beneficial. And there is exchange of currency, there is this investment, the money supply that is coming in, which builds adequate financial infrastructure for the country. And thus foreign investments also plays an important role, which is served by trade finance. Thank you for watching. I hope this video helped you get some insights about international trade finance. Go through the playlist and watch all the videos that is uploaded. It is in a sequence and you can go through all the videos. Thank you so much. Keep up the support. Bye.